I'm going to take you through the steps of running a discounted cash flow model to figure out the intrinsic value of Lowe's stock. Lowe's is a giant retail store that people go for mainly home improvement purposes. They have 101.7 billion in market cap, so it's a very big company. And next we need the market price, which is 134.71. And now we can figure out the shares outstanding because it's just the market cap divided by the stock price gives you the shares outstanding, 755 million shares. Next we're going to get the free cash flows. And this is how you value a company. You estimate the future free cash flows and then you discount that dollar amount back to today's value. Now I'm pulling the net income, which is the profit and loss, and that's on the income statement. And then I'm going to take the revenue, which is the sales, also on the income statement. And you want to take a quick look at the numbers just to make sure they look okay and fairly consistent. Because in order to run a DCF model, you need consistent numbers and you need positive numbers. Because if either of those things occurred, it would give you a value for the company which wouldn't make sense. So these numbers look pretty good. Also, the revenue seems to be increasing every single year, which is a great sign for an investor. Now we need the interest expense. And that's the interest Lowe's pays on its debt. And they pay $720 million of interest last year. Now let's see how much debt they have. We'll go to the balance sheet. We'll go to the current liability section. So the current debt is debt due within 12 months, 2.5 billion. And long-term debt of 16.8 billion is debt due after 12 months. So they pay 3.7% interest on their debt. But interest is tax deductible. So let's get their effective tax rate. So in 2020, they had 5.6 billion of income before tax, and they paid 1.3 billion in taxes. So when you deduct the interest rate from the effective taxes, their actual cost of debt is 2.83%. Now let's get the cost of equity. We need the beta for that, and the beta is the volatility of the stock. And the higher the beta, the more volatile the stock is, and the higher the WACC. So 1.42 is their beta. So we need a little more information. Let's go back to the balance sheet and pull their current assets. These are assets that can be changed into cash within 12 months. So it's cash, accounts receivables, inventory. And they have 15 billion of current assets. Now we need their current liabilities, and these are liabilities and debts that are due within 12 months. So ideally you'd want to have more current assets than more current liabilities, and that is the case, just by very little though. Now we need the equity. That's the total assets minus total liabilities. That's $2 billion. Also, we're going to get their EBIT, earnings before interest and taxes, or operating income. This is the money Lowe's makes from its operational everyday business, but it's before they pay interest expense and taxes. So now that we have those numbers, we can see the capital structure is 91% debt and 9% equity. So it's very leveraged. So in order to get the WACC, it's a blend of the cost of debt, 2.8%, and the cost of equity, 13.2%. So they have a weighted average cost of capital of 3.8%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value for the company of $110 billion. We divide that by 755 million shares, and we get an intrinsic stock price of 146. It's trading at 135, so it's trading at an 8% discount, so it's a buy according to the model. And you can see historically, they were trading way lower when coronavirus hit. Looks like in the 70s. It would have been a really great buy if you got Lowe's when Corona hit. Let's see what Simply Wall Street says the stock is worth. They calculated the value of the stock at 145. That's their intrinsic value calculation. I'm at 146, so it's really, really close. Usually we're a little off, like maybe 5-10% off, but we're really close in this case. That just shows you that Lowe's has consistent numbers that are easy to value. When you look at a startup that has numbers all over the place and negatives, it's impossible to value those companies. So the stock price can always move higher or lower than intrinsic. It's really supply and demand of the market. Back when Corona hit, everybody was selling their stock and it drove the price lower and lower. But then once things settled and people realized the world was not ending, they started buying Lowe's again and they drove it way past to its all-time high. So now that's where it sits. I'm still calculating it as a buy, but it's not as much of a buy as it was a couple months ago. Let's look at their financial ratios. So their price to earnings is 24. That's about the average of the entire market. And the median for the entire market is 16. And they have a price to sales of 1.4. That's price of stock over sales per share. That means an investor is willing to pay $1.40 for $1 of sales. And when I say sales, I just mean the revenue, the $72 billion. Next is price to book. They have a really high price to book of 51. They have so much debt in their capital structure, it really weighs down their balance sheet, and it makes their equity so low. So their equity is only $2 billion. And when you compare that to $39 billion of assets, that's a pretty low equity number. And price to book is just price of stock over book value. And all book value is total assets minus total liabilities. They have an okay current ratio, it's 1.0, so they can cover their current liabilities. Their ROE is through the roof just because they have such a low equity. And ROE is income, net income, remember the $4.3 billion from 2019, over the equity. So they're providing a great value to their equity holders. Next is interest coverage ratio, and that's no problem. They can cover their interest 9 times. If you see a company with 91% debt, I would look at their interest coverage ratio. Let's compare Home Depot to Lowe's. So they both have a similar price to earnings of 24, which isn't so great. They both have a good price to sales. They both have a weak price to book. Of course, Home Depot is negative because they have negative equity. Both have a decent current ratio. Lowe's has an amazing ROE because of their low equity. You can't look at an ROE with a company like Home Depot because they have negative equity. Why does Home Depot have negative equity? Let's look at their balance sheet. So we need to go to the 10K to look at Home Depot's balance sheet, because if you go to Yahoo Finance, they don't really provide all the information. They have assets of $51 billion, they have liabilities of $54 billion. You generally don't want assets less than liabilities. It's kind of like owning your house and it's worth $100,000, but your mortgage is $120,000. But the main reason Home Depot has negative equity is because they were so aggressive with buying back their stock. Home Depot went out into the market and purchased stock just like we purchase stock at whatever the price they're trading at, and put it onto their balance sheet as treasury stock. So what happens when you buy stock? Just like when we buy stock, our cash goes down, and this is how you improve the PE ratio, or a lot of ratios is you take the stock off the market. When Home Depot actually buys the stock, those shares are removed from the market. So now it's a smaller number of shares, so whoever currently owns the stock gets a bigger piece of the pie. So it may sound manipulative, and it is a little bit. So at any point, Home Depot can take these $65 billion of shares and put it back into the market, and they would get the cash for it. Just like when we sell shares, and their cash would go up, and then their balance sheet would look amazing. So this is the kind of analysis you need to do sometimes to really figure out why things are the way they are. And now look at a company like Hertz. This is Hertz balance sheet, and they have $1.8 billion in equity. So their assets are $1.8 billion more than their liabilities. So someone may say, this is good. It's much better than Home Depot. 2019, Hertz had negative $11 billion in cash flow. And before that, they had negative $10 billion. They're leaking cash like there's no end. This is not what I would invest in. And when you look at Home Depot's free cash flow, in 2019 they had $11 billion. In 2018 they had $10.5 billion. So even though they have negative equity and tons of debt, they can easily pay their debt. So they can easily pay the interest on their debt. They could almost pay off half their debt in just 1 year. So they have plenty of cash. So you have to look at so many different things. It's really interesting to look at a company like this because an investor who has very little experience looking at balance sheets and financials would think this is an awful company. A more seasoned investor may feel this company is doing things in a certain way in order to generate the most income. Sure, it may not be the best approach, but if you look at all the numbers, they're not doing bad at all, and some may even say they're doing pretty well. So please leave a comment, even if it doesn't have to do with this company. You can talk about options and yields, anything you want. I love to answer those types of questions. Thanks for watching.